The American mall apocalypse is accelerating at an alarming rate, with 15 major shopping centers across the nation facing unprecedented customer exodus. In just the first quarter of 2025, foot traffic has plummeted by a staggering 47% compared to pre-pandemic levels, marking what experts are calling the final nail in the coffin for these once thriving retail landmarks. Let's dive into why these specific malls are dying and what this means for the broader American economy. First up is the Destiny USA Mall in Syracuse, New York, which has seen a 65% decline in visitors since 2019. This 2.4 million square foot mega mall, once the pride of upstate New York, now stands with over 200 vacant storefronts. The mall's owner, Pyramid Management Group, recently defaulted on its $715 million mortgage payment, signaling severe financial distress. The Woodfield Mall in Schaumburg, Illinois, historically one of America's largest shopping centers, has lost 4 anchor stores in the past 18 months. Their vacancy rate has skyrocketed to 38%. And property values have plummeted by 45% since 2022. The latest data from Simon Property Group shows that foot traffic has decreased by 52% compared to 2019 levels. In California, the Westfield Valley Fair Mall in Santa Clara is experiencing a mass exodus of luxury retailers. Despite a $1.1 billion renovation completed in 2021, the mall has lost 27 high-end stores in the past year alone. The property's market value has decreased by $320 million, according to recent county assessments. The Mall of America in Bloomington, Minnesota, despite its status as a tourist destination, has seen visitor numbers drop by 35% since 2019. The triple threat of e-commerce growth, changing consumer habits, and rising operating costs has forced the mall to convert 300,000 square feet of retail space into office spaces and entertainment venues. The King of Prussia Mall in Pennsylvania, once considered recession-proof, has lost 42 stores since January 2024. Their anchor tenant, Nordstrom, recently announced plans to downsize their footprint by 60%, while Macy's is considering complete closure by year-end. Florida's Aventura Mall, despite its location in a wealthy demographic area, has seen a 40% decline in sales per square foot. The mall's owner reported that 28% of its small business tenants are behind on rent payments, with many operating on month-to-month leases. The Galleria in Houston, Texas, has lost 45% of its luxury brand tenants since 2023. The mall's operator has been forced to offer rent reductions of up to 30% to retain remaining retailers, while still seeing an exodus of established brands. In New Jersey, the American Dream Mall, which opened just before the pandemic, is struggling with a 55% occupancy rate. Despite its massive entertainment offerings, the mall's financial troubles have deepened, with $300 million in losses reported in 2024 alone. The mall at Short Hills, also in New Jersey, has seen its property value decline by 38% since 2022. High-end retailers are increasingly moving to street-front locations, leaving behind vacant storefronts and declining foot traffic. Tyson's Corner Center in Virginia, once a blueprint for successful mall operations, has lost 35% of its specialty retailers in the past 18 months. The mall's owner has begun converting retail space into medical offices and educational facilities to maintain occupancy. The Fashion Show Mall in Las Vegas has seen gaming revenue surpass retail sales for the first time in its history. The mall's retail occupancy has dropped to 72%, with many stores operating on reduced hours due to staff shortages and low customer traffic. South Coast Plaza in Costa Mesa, California, despite its luxury positioning, has experienced a 25% decline in sales volume since 2023. The mall's operators have been forced to increase marketing spending by 40% just to maintain current traffic levels. The Ala Moana Center in Honolulu has seen tourist spending drop by 55% compared to 2019 levels. The reduction in Asian tourism has particularly impacted luxury retailers, with several flagship stores closing or reducing operations. Woodfield Mall in Garden City, New York, has lost 32% of its small business tenants since 2024. The mall's owner has begun offering pop-up locations at reduced rates to fill vacant spaces, but long-term occupancy remains a challenge. Lastly, the Scottsdale Fashion Square in Arizona has seen its average store size shrink by 40% as retailers downsize their physical footprint. The mall's luxury wing has lost 15 high-end brands in the past year, despite the area's wealthy demographic. These declining malls represent a broader trend in American retail. According to the latest data from the International Council of Shopping Centers, mall vacancy rates nationwide have reached 12.4%, the highest level since they began tracking in 2000. Credit Suisse predicts that 25% of America's remaining malls will close by 2027. The impact extends beyond retail. These malls collectively employ over 100,000 people and generate significant local tax revenue. Their decline affects municipal budgets, property values, and local employment markets. Real estate research firm Green Street Advisors estimates that mall property values have declined by an average of 45% since 2016. E-commerce continues to be the primary disruptor. Online sales now account for 21.7% of total retail sales, up from 11.3% in 2019. Amazon's market share in particular has grown by 32% since 2022, while traditional mall retailers struggle to compete with the convenience and pricing of online shopping. Demographics also play a crucial role. Younger consumers show less interest in mall shopping, with Gen Z spending 27% less time in malls compared to millennials at the same age. They prefer mixed-use developments and street retail, forcing malls to reinvent themselves or face obsolescence. The solution isn't simple. While some malls are successfully transitioning to mixed-use facilities, incorporating offices, healthcare, and housing, others lack the capital or market conditions for such transformations. The cost of converting a traditional mall can exceed $100 million, making it unfeasible for many owners. The implications for commercial real estate are severe. Mall-backed securities are experiencing increased default rates, with $13.5 billion in mall debt coming due in 2025. This crisis could trigger a broader commercial real estate downturn, affecting everything from office buildings to apartments. The death of these malls serves as a warning for the retail industry and commercial real estate sector. As consumer habits continue to evolve and e-commerce grows, the traditional mall model becomes increasingly unsustainable. The question isn't whether more malls will close, but rather how quickly and what will replace them in America's retail landscape. For investors, property owners, and local communities, the message is clear: adapt or face extinction. The American mall as we knew it is dying, and its transformation will reshape not just retail, but the very fabric of American communities.